Good afternoon, everyone. This is the last week in Mortgage Today. I'm Faith Howard Mooney, the VP of Member Engagement at the Mortgage Collaborative. And I have with us today is someone who is well known in the industry and someone that we always love chatting with, Sarah Gonzalez, who is the president and COO of Panorama Mortgage Group. Thanks for being with us today, Sarah.
Thank you for having me, Faith.
Yeah, not a problem at all. I thought we'd start out today with something that's a little bit different than a lot of the things that have been talked about in the last week. As many of you have probably seen in your social blasts, it's Women's History Month this month. And I didn't ask you this before. I'll put you a little bit on the spot. Favorite woman from history? Do you have one? I mean, there's many of them.
And is it terrible that I might say my mom? But that's a hard question. I have not prepped for that. So I would say off the top of my head, probably my mom right now, but thanks for the question.
Moms are the best. Mine is Maya Angelou. There's nothing like her great voice and the words that she spoke. And I usually don't have one up yet, but I will eventually on one of my walls have one of her quotes on one of my walls where my new desk will be. So that is the plan. But kind of in that vein, I saw something this week that was really, really interesting in that Wells Fargo had done a story and some research looking at the economic impact of single women being one of the largest growing segments in the labor force, as well as is driving like consumer spending and some of those other things. So maybe because I'm a little bit out of touch, I am a single woman, but the percentages there just shocked me that were in their survey. As of 2021, 52% of women are unmarried or separated. And that just, to me, seemed like a very, very large number. How about you?
No, that does sound very large, and quite coincidentally enough, over the weekend, I spent some time with some of my industry favorites on a little road trip, and this came up in part of our discussion. So just by pure chance, we're talking about this today. And we were talking about this exact thing. One of the very highest growing markets right now are single women, whether they've been married or unmarried. And that how the affordability factor comes in with these single women, especially if they have children and other dependents that they have to take care of, outside of a marriage or a divorce or whatever the case may be. So it's just interesting that you chose this as a topic, but knowing you being a Women's Month, this would be at the top of your list. But yes, we were discussing this as a group over the weekend, and it's interesting to see, like, what are we doing about it, right? I think me and my own role here at PMG, which if anyone's aware how we run our brands through DBAs here, one of the discussion topics when we were thinking about underserved communities last year, and I was talking about target DBA opportunities, women was one of those target opportunities. Again, want to be really careful with my words here, but there are affordability issues within that segment today as it stands. And to your point, it's 52% of the women in the United States.
And the other percentage that was kind of like shocking to me is there was a 20% increase over the last decade of single women households who had never been married. So never married, not divorced. That segment also, it's like if they tracked never married women compared to never married men and what they earned. And they earned 92.1% of what the never married men earned. So maybe a lesser gap than some other segments of women compared to men in the industry, but still a gap nonetheless. 8% is a lot.
Yeah. And I could probably spend 30 minutes talking about all the reasons why there's a 20% increase of single women year over year, but we won't get into that. But yeah, again, very, I don't think that's news. I mean, I think that's been a struggle, right? I think we've done better as the years have gone on, and we've talked about, pay inequity between women and men, and how a lot of companies are doing a better job of aligning those things and really taking a deep dive into their company. So look, at the end of the day, while these single women, maybe by themselves, it doesn't mean that they have any less responsibility, right? Meaning taking care of parents or friends, or, maybe they're involved in other things. I don't know, but it's interesting that pay inequity is still there by 8%. Again, I think if we look at years past, that's gotten better. But when it comes down to affordability, it's getting tougher.
Yeah, well, and one of the things that they went into in this research that they did is how payroll then impacts the wealth gap. So that's what payroll is, 8%, but the wealth gap widened to 29% among never married women, even when they took into consideration their age, their education, whether they had children or not, and whether they owned a home or not. So, it's kind of one of those situations that we talk about other segments a lot, but I thought it was very interesting to just see a study strictly on women and what it did to the wealth gap, which of course, goes right into why do women own or not own a home? The scarcity of homes right now and the cost of homes right now, how that 29% comes into play for this particular segment. So I thought.
May I put you on the spot, Faith?
Sure.
On your research, did you find anything with regards to household incomes where the woman only supports the family?
I have not seen that anywhere yet. I didn't specifically look for that, but I will.
That might be an interesting thing to look at as well, in that, costs have gone up. I think, I can speak for myself as well as some others. We've made adjustments with regards to just the changing market and making sure that, we're looking out for our company's best needs and things like that. But how does that affect the household where, the woman is the only provider, right? We have a lot of stay-at-home dads, which are just, it's awesome, right? It gives us the opportunity to grow our careers and whatnot. But when there's huge impacts like that, and or prices go up just in general, right? The cost of groceries, the cost of gas, the cost of childcare, all of those things go up, taxes go up, everything, and the woman is specifically responsible. The same case would happen, right, if a man was in there, but with the gap, right, from an 8% perspective, that's a big deal. If they're having to.
That 8% is a better gap than what the gap from all women to all men, I believe, is, because I think that's much higher. This was just single women to single men. So in that category, it's better. But I think if you get into married women or all women in general versus all men in general, there's still a much bigger gap than that 8%. But interesting information in Women's History Month. So just that may be a good place for us to start. Other things kind of in the news this week, of course, this last week was announced the delayed rollout of the LLPAs related to DTI. Would just love, it appears we had Chris Dickerson with us at our conference in San Diego several weeks ago. It appears that people are listening, but would kind of just love to get your feedback on that and on LLPAs in general.
Can I say that I'm happy, frustrated? I guess thankful maybe for the delay. Maybe it gives them more time to brainstorm on other ideas. I hope that's what they're using the time for, and not just, hey, it's paused because we have a technology constraint or a way to track it. But I hope that the pause is to really kind of thoroughly rethink the positioning of that additional LPA for DTI. Because again, the constant theme here for this year is going to be affordability, right? And outside of affordability, it's also just going to be a pain internally to build streamlined processes when DTIs are fluctuating and you're having to add a LPA and you're not having to add a LPA. But again, I think when it comes down to the consumer, this really is just going to roll back on them. And even if you price accept it at some point, from a pricing exception standpoint, that's still not going to be great, right? That's not really great for anybody. So it's just interesting, I guess, that they paused it again. Happy that they're taking the time to hopefully rethink and brainstorm on other ways that they can look at this. But I have calls with Fannie Mae all the time, Freddie Mac sometimes, but you know, I have calls with our investors all the time, and what I'm getting is, hey, we really love PMG, we love its commitment to the underserved communities, and then you go into the next email and you see, wham, you know, this is going to be coming, and it kind of just puts you at a pause when their focus is really on these kind of ESG initiatives and how do they work through those. And then you have something like this. So I hope that they're taking the time to really think through how does that align with even their own objectives around underserved communities. And then again, like at the end of the day, it's going to come down to an affordability issue if it comes out in August. So
I think that when we had a small group of people that met with Chris Dickerson at our conference, there were a number of things that came up, and just not when the notification came out, it said, you know, because of technology issues and everything, but there were a number of things outside of technology that came up in that group. And one of them was, you know, you're going to be doing more verifications if this is the case, which we all know that more verifications means that's exactly
going
right.
up, right?
Up, everything is going up, and so more verifications mean the costs are going up, which it seems like, you know, like you said, some of the things, their initiatives is to not put up, one of their initiatives is no barriers or lesser barriers for people related to home purchase. Well, again, when costs go up, that's a barrier. When the process, the consumer is confused about the process. I think, you know, it's like you qualify at the beginning, but then there's something that changes, and now all of a sudden, maybe you don't qualify. You know, partway through the process now, it's like it's all changed and the pricing's different and you don't qualify. That leads to not only consumer confusion, but also lack of trust, I think.
Yes, absolutely. And I already feel like the change in circumstance process for a consumer is confusing anyways, right? To the average consumer, you know, are they laying out each LE or each closing disclosure and okay, what changed? Or are they just, you know, having a really good relationship and discussion with their LO and they understand what they're signing? And then, you know, do they really even understand what a DTI is and why they're being charged something differently? Like, yes, we should be doing home buyer education. Yes, your LO should be walking and processors should be walking them through those things from a retail perspective. But at the end of the day, it comes down to the consumer, and we all know that consumers only know what they're taught, right? And if they're not taught anything, unfortunately, it's just going to cause more confusion. And I think it will also cause folks to shop around more than what they probably are.
Agree. And they might get one answer at another place that they get midway through the process, and then things are, you know, either not disclosed or found out, or something changes and they're going to experience the exact same thing.
I mean, they're not going to see that hit, but they may go to a lender that might PE it, right? And it doesn't, to them, it doesn't exist anymore, right? It's just a price thing. So Either that or they're having to buy discount points to buy it down. So either way, it's just more cost to the consumer. It just lends to this whole entire affordability issue that we're stuck in today. So again, to my point, when we first started talking about this, I hope that they're really taking the time to reconsider the effects of this, and are there other ways to solve what they're trying to achieve, rather than making it more difficult on lenders and making it more difficult on consumers at the end of the day.
It does appear that they are listening. And we've heard that from numerous people. I know that our membership has felt more that way since Sandra Thompson has become involved. That she does want to hear, she does want the feedback. We will, from TMC, be sending them a letter addressing some of the things that came out of the conversation that was had at conference, but it does appear that they're listening. So I would encourage everyone on this call, reach out to, your associations, the MBA, anybody that you can related to this issue. Because I think that, what you've shared, Sarah, is kind of what everybody's feeling right now, that this is going to harm the people that you were trying to, the unintended consequence is it's harm the people that you were trying to help.
I will tell you, I know you keep saying people are listening, but for those of you that came to the San Diego event, it might have just been Jody Hall strong-arming Chris on stage.
Got a little bit of that too. There was a little bit of that too at the same time. We don't really need to talk about it, but I would love to get Jody's on with us.
Everybody give Jody Hall an applause.
Not afraid. She is not afraid of anything. She was poking a little bit at people related to that topic for sure. The Fed meets tomorrow. There's not really anything to talk about, but I would love to see everybody's feedback in the chat. It's a guess because you can't do anything other than that. But I did notice, so I flipped through a bunch of Sunday news stories, different channels, different stations, to try to get like a good feel of what people were talking about. And it seems like everybody was talking about this on Sunday. It was very interesting. There was no consensus of what was going to happen with the Fed on Wednesday. Some people were saying, they kind of put themselves in a corner, that it's going to be, a 0.25. Some of them said, no, with everything that's going on with the banks, it's not going to be anything. It was just very interesting. So I just love seeing everybody. It looks like 25 basis points is what's most prevalent in our chat. So we'll see tomorrow what happens with that one. This week as well, the Mortgage Bankers Performance report came out. And speaking of like things going up, it came out that the increased high per loan cost $12,450, which, it includes, commission, compensation, all of those things, occupancy, equipment, all those things in it. But that's huge. And so then you start tacking on, we're going to have increased credit fees that may or may not have impacted that a little bit yet. You're talking on potential LLPA, things that increase things. I mean, it's the cost of producing a loan is just huge right now. So again, feedback on like, what are you guys, other people in the chat as well, what are you doing to try to bring those costs down? What haven't you done already?
I mean, from a PMG perspective, we're clearly seeing it on the credit side. And a lot of us knew that this was coming, right? And already starting to kind of work through, hey, what is absolutely necessary? So if I think back to my entire career, right, we've been in these influxes and low fluxes of, hey, we need to, we go after the shiny objects, we implement them, and then we go into a down cycle. And then it's like, okay, do we really need all of that stuff? Are we getting our ROI? And so some of the things that I've shared, even at the ICE conference, speaking with ICE specifically, and even in this conference and just in general, and I know that we talked about this in our own lender roundtable at TMC, is that people are really starting to look at, you know, what it actually takes to have a compliant and sellable loan, and how do you drive down those costs. They're looking for different ways. I know ICE is changing the way that they're now setting up contracts. So for those of you that aren't in Encompass, that haven't already, that have maybe been on it for a while and are coming up for a renewal, or if you've already gone through a renewal since over the last couple of months or few months, you know, they've changed how they're pricing. And I think it really comes down to, yes, they're still trying to make their bottom line, but there's a lot of discussion around, and I'll give you guys an example. You know, their previous options were you got a number of seats and a number of loans, and whichever was the highest is what you had to pay. So just to give you guys a little bit of context, because we're in a safe space here, is that, you know, we were paying $70,000 a month for 700 seats when I only have, let's say, half of that, maybe a little less than half of that in seats, like actual people using Encompass. That's number one. And number two, the per loan cost at the end of the day was more equivalent to what we were actually doing from a seat perspective. But I'm having to pay double for my LOS, right? So then it starts making you think, well, do I need to get away from this provider? Okay, if I do that, then what is that going to mean from a capacity and like a suction of human capital within your own particular organizations? And so I think a lot of people are having discussions. I think Jody's been working on her little project for quite some while, so I know she's on the call. Another little shout out to her. But again, you know, these are all things I think people are really starting to look at of what do I absolutely need to sell a compliant loan to agency or a downstream investor or whatever the case may be, and do I really need all the other bells and whistles? And if you are going to have the other bells and whistles, you have to have a quantifiable return on investment calculation that you can back it up against, because at the end of the day, you're not watching that ROI and making sure that what you thought you were putting into it, you're not getting out of it, then you need to probably reconsider that relationship. But PMG is no different than anyone else in that we are seeing rising costs. I don't think that $12,000 number includes the credit report fees, because that's from fourth quarter, but I could be wrong. But I can tell you right now, they are double. They're double than what we are seeing. You know, we talked a little bit, Tracy King talked about this at the TMC event around, you know, the ability to start entering in other processes. Oddly enough, we had a conversation about this morning in our own company, where I've been trying to put in a soft pull process, but I'm limited by the vendors that I use, what I can do and what I can't do. So even though I've been driving for almost a year now that I want to have this process, I've been handicapped by my vendor because they've been a pilot forever trying to do this, right? So, you know, we have found ways to get around that, but at the end of the day, it increased my cost because it's a more manual process. So I think people are just really trying to take a look at what makes sense and what's causing headaches. And if you don't have a partner that's willing to come back to you and say, I'm willing to work with you, or I'm willing to get this done, a lot of folks are just saying, I'm done, you know. That's our take, at least from a PMG perspective. I don't know if anybody else is.
A lot of at conference that, again, you mentioned it briefly, that we implemented all of this technology, but we either don't have adoption of it enough that when you go back and figure out what it saved you, if you don't have adoption of it, then it's probably costing you money, as well as a lot of people renegotiating things. At one point, it was, I think, renegotiating to one single provider and hoping that using a lot of their different services were, you know, going to get you a better cost. But this time around, we kind of heard a little bit different story related to cost, in that maybe if you work with multiple providers, and have more of a waterfall for some of your products, that it goes one place if it's one thing and one place if it's another, then they're competing against each other. Some people were having some success with that and trying to drive those costs down a
I
little
would
bit.
just say, the only thing I would say, Faith, is it's not just about cost. Okay.
Right.
Because I'll be honest, we have some sales folks in our group that like to do some of that back and forth stuff. At the end of the day, though, even if they get the better price, the process is horrendous.
Right.
It
Well,
doesn't work.
and
There's no
else.
there's no synergies between what you're trying to do, and if you're doing it just for cost, yeah, that might work. But at the end of the day, if the click difference is, 5 clicks versus 3 clicks, what do those 2 additional clicks cost you in overall cost? We look at this $12,000 number. And again, we might be talking about dollars here, but dollars add up if you divide them by, or I'm sorry, if you multiply them by units. The savings are pretty incredible. So I would just say, yeah, I heard the same thing you heard, Faith, where people are playing rate card warrior with each other. Yeah, that might work, but just think about the overall impact long-term of what that does to your manufacturing process.
Ultimately, if your manufacturing process isn't working well, somewhere in there you have people expense. I mean, if there are manual things that need to be done, then you have to, that works into the equation as well. Agree with that. It was just interesting to kind of see the shift of what had been talked about at one point and kind of where people are at today. We are down to 4 minutes left today. It goes by so fast. I thought at the end of this, we would just briefly talk. Everybody's been talking about it, about what is happening in the banking space. And again, interesting in that in some of the things that I researched this week, and then also programming that I watched, I heard the word crisis a lot. And it's, I was in the mortgage space. I'm sure you were in the mortgage space probably back in 2007, 2008 as well. The word crisis being brought up when it just was interesting to me. It seemed like it was a lot of headline news when it doesn't appear that on the banking side of things, that's kind of where things happened. I think everybody knows that the quality of credit is way better now than what was going on back in that day and age. And when I looked at it initially, I saw it as more of a hedging type of issue and performance of a bank versus a major overall banking industry thing. I don't know if you have any feedback on any of that at all and what's happened with the FDIC coming in, and Flagstar apparently has agreed to assume all deposits and certain loan portfolios for Signature. Of course, Silicon Valley Bank, we know what that kind of came in as with them making sure that everybody's cash was safe for the people that have withdrawn a lot of cash. But I don't see it the same way as 2007, 2008. I don't know if where you were in the industry during that time period, if you see this as a similar thing or a different thing, or have any feedback at all?
I mean, I do think there are some similarities in just the shock and awe of like, oh my God, here we go again, but I do agree with you to some point, it is slightly a little bit different. I do think the overall requirements today, and again, I'm not in a bank. I haven't been in a bank in a really, really long time. So I'm not completely up to speed on everything, all banking. So maybe somebody that's on here that has that's working for a bank or has some additional insight, feel free to pipe in on the chat. But I do believe overall, the CFPB, which we could probably spend 30 minutes on, I think there's been a little bit of ruffle around that. And I tried to get to a story this morning on Dodd-Frank's page because they are looking for some reform around that. And like, what are we going? So, being able to go back to banks and ask for millions of dollars, which then puts them in these types of positions. on something that they already procured before. So I think there is some differences in what was happening surely between 2007, 2008 to this, just because of the CFPB factor. But again, I would be curious to hear what anybody else has to say on the matter. And I do think there's a lot of concerns, at least from my perspective as the president of a company. What are those reforms going to look like? And are they going to go back and change things that were actually good for us to have some regulation around? And, you know, what will be grandfathered versus clean collated? You know, I don't think anybody really knows that yet. And even if I could pull up that entire article myself, I don't even know that the article, I can only read parts of it, but if that article even went into detail, but I just know that that's some reform is going on or being talked about at least. And I think that's a little nerve-wracking, at least from my perspective.
Yeah, the one thing that I heard, which again, no detail, because I think it's probably just way too early to have that, but tougher capital and liquidity requirements. And then of course, the one thing that always happens when something like this happens is you immediately hear the more regulation words come into play, which if it's the right regulation, you know, maybe it's okay, but more regulation just for more regulation probably isn't necessarily a great thing to have happen.
Yeah.
I appreciate you and your willingness to do this with me today. I can't believe a half an hour has went by already. Look forward to, it looks like we do have some feedback coming in that we will get out to people if we need to, but it's been great talking with you. Appreciate your time in doing this. Appreciate everybody joining us. And for those who listen via podcast, where you can find us as the Mortgage Collaborative, please join us at some point in time for one of these live. We'd love to see people in the chat and people participating with us. And we will see you back here next week.
Thanks for having me, Faye.
Yeah.
Bye, guys.
Bye.